Welcome to the deep dive video update. This is a weekly video that I do where I pull out the charts that maybe I used throughout the week and then stop using, or other charts that I didn't use at all. And then there are some additional charts that I put just into this particular video, and we have to look deeper to see if we're getting any insight from these charts. That's why I come up with the name Deep Dive. A little bit different context than what you might hear otherwise. And we just see, are there any clues, any insights, any things that we can get from looking at these individual charts? This is being prepared for Monday, December 1st. Now, before I get into that, for the month of December, I have a thing called the SPX investing program, and it's completely free. So I changed the permissions on there. So if you go and sign up at spxinvesting.substack.com, all you have to do is provide an email address. And for the month of December, you can check everything out and see if it is of benefit to you. All right, the first chart that we look at is unique just to this particular video. It's the long-term range of the VIX. And even though we were going up with the VIX a week ago, the market was not looking all that good. We had just a monster week, the week of Thanksgiving this past week. And with that, we're still in a lower range with the long-term look at the VIX. Now, when we were really going down on the daily side, the VIX was well above 20. It's still well below 20 longer range here. This is a 50 period moving average of the VIX. And so in a general sense, when we're more positive, the VIX goes into a lower range. When we're more negative, the VIX goes into a higher range. Even though we've been coming back up and been under a bit of pressure here, we're still well under that 20 level. So this is taken as positive. Then we want to measure the momentum of the VIX, where it was really going up and the MACD was going up. Now that we're starting to come back down, not surprisingly, the momentum as measured by the MACD is going down as well. Then we measure the speed of the VIX. Now, I was using this not too long ago. This is an RSI, short term, based on 9 periods. And when the VIX really shoots up quickly, then the RSI really shoots up quickly. We kind of topped out over the 70 level, and now we've been pulling back, and now things are a little bit more settled. Then we look at the VIX to S&P correlation. And we're not getting a high reading now. Very low reading, not really getting any insight from this chart. We pay attention to this when it goes above the dash line here. We did get there last October, and then we came down from that reading. It was very useful at that time, but we're not really getting much use right now. And we look at the volatility of stocks measured by the VIX, volatility of bonds measured by the MOVE index, and we're dropping down here, but the red line is still tending to go up. That's what I pay attention to. Now, when we were coming down here, that's when the S&P was going up. That means stock volatility was less than bond volatility. And now we've been seeing this picking back up. We go back to September and the red line's been going up. And we've still been going up here with the S&P as well. And then we really drop down. And we'll have to see if we roll over here, that might end up being more positive. It's really difficult with this chart to get a hard and fast rule because there are times when the red line's going up and the S&P is going up. There are other times when the red line's going down, but the S&P is still going up. So we don't want to try to say, okay, this is the way we always interpret this chart. We want to look at the context and then use this in conjunction with other sentiment gauges that we're following. Then we look at the VIX, and then there's an indicator called the VVIX, or the volatility of the VIX. How fast is the VIX itself moving or being volatile? And that has picked up here when we look at the 50-period moving average. Now, generally, when this is going down, that tends to be more positive for the S&P. This is still going up. Now, we were looking pretty negative a week ago, but then we reversed, and it's going to take a little bit of time if this is going to roll over and go down with this 50-period moving average. So we'll keep an eye on that. I mainly use this just for informational purposes as well. Then the skew index, it did come up into the red area, and then it's dropped down. Now it's not really giving us a signal. This is a different way of looking at sentiment using out of the money options where it's calculated, where the VIX is using at the money options. So sometimes we can get some insight from this chart, but it's really not telling us all that much right now. And we look at the ratio between large caps and small caps. Now, this fell over the last couple of days because a week ago, this ratio was going up because the Chair Powell had come out and some other folks that are on the FOMC said, well, we're not so sure about that rate cut in December. And small caps don't like that. And so even though large caps were getting hit, small caps are getting hit even harder. And so we were seeing this ratio going up. Then this past week, some Fed governors came out and said, well, we might be interested in a rate cut in December. The market really liked that. They're pricing that back in. They're pretty much anticipating that. We've got some big inflation data finally coming out in the upcoming week with the core PCE later in the week. And then after that will be the jobs report and then CPI later on. And so now that the government's back up and going again, we're starting to get these reports. And so the market is shifting back and it's taking because the market always develops its own scenario, whether it's positive or negative. Now, a week ago, the scenario was pretty negative, but then it's now switched back over and is looking more positive. And small caps like that there could likely be a rate cut in December. And so that's why this ratio has been going down. When this ratio goes down, that means small caps are outperforming. But in the bigger picture, we're not seeing all that much of a change yet. We're not seeing any real conviction other than short-term moves up or short-term moves down. This over a period of time, over many years here, this just shows how large caps have been outperforming. Then, just for informational purposes, we look at the percentages of major lows that were set, like October 2022 and then October 2023. And then where are we now on a percentage basis? And then we go back to the low that was set last April. And these are pretty impressive returns since that time. But this is more just out of informational curiosity. This also, now this can actually be useful, but this is also trying to measure what the percentage moves have been. A week ago, when I was looking at this chart, we were starting to measure the high that we set back in October, and then how much have we declined on an intraday basis. Now, usually the market uses closing basis. All right, so we look at that too, but I also want to keep an eye on the intraday movements as well. And we were down about 5.6% from the all-time high, and we had pulled back. Now we're starting to go back up here, and that just shows that this was a pullback to this point. Now, in the upcoming week, who knows what's going to happen? Are we going to be able to break above these previous levels and set new all-time highs? The market's still looking a bit vulnerable from a growth versus value perspective. We're going to need the growth areas of the market to really come in and do some buying. That would really help the market an awful lot. Right now, it's been lagging, and it's been lagging over the last couple of months. So we'll see if that growth comes in and there's some buying and a lot of the really big mega cap stocks continue to do well, then yeah, we might see another push here higher. We're also dealing with positive seasonality right now. So we'll have to see. But if we get to the point, we're not there yet. We're still quite negative as far as sentiment. We're working our way back up and to just being extreme negative. We were extreme negative there. When we had that big down day a week ago Thursday, we got down to 6 with the daily reading that we look at. Now we've been improving, but we're still at 24 right now. That's still extreme negative. That's a daily chart that we look at. And that probably is what kind of helped the market bounce because everybody was pessimistic from that aspect. There are other sentiment gauges that we look at where bigger picture, longer term, where folks are still rather euphoric about things. But the market doesn't like to be taken for granted. And so then it started to go down. Now it's starting to go up. Now, if we shift back over to a stance where, oh, positive seasonality, Santa Claus rally, the Fed's going to cut rates. All right, that can last for a while and it can be positive. But when everybody starts to see things in the same way, then that's when we look at taking a contrarian type of approach with our analysis. But getting back to this is just a normal pullback. This happens, even though it's more substantial than what we've seen since we came up out of the lows last April. It came down. We actually broke below the 50-day moving average, but then we were able to get that back, which is a positive thing. We're also positive in the short term. We were able to get back above the 20-period moving average. So there is some improvement there. Then we just want to keep an eye on the different advanced decline lines here. We are setting a new high here with the advanced decline line for the S&P based on price. We're leading a little bit based on price. We're lagging a bit here based on volume. Now, I did show this in the latest daily video, but this is just an area we want to keep an eye on. Now, it's good that we're setting an all-time high here, but we want to be a little bit careful because when the market's a little stronger, we typically will see volume breaking out and showing strength before we actually see it in price. And we're not seeing that right here. Not a big deal, but just something that we want to keep an eye on. And then the NYSE common stock based on price, not quite back to an all-time high, but really recovering after it had been going down. Not quite back to an all-time high here based on volume, but also really showing some improvement. And then we look at the S&P and then the NYSE advanced decline line. They're pretty much going in lockstep with each other. That's showing more broad participation across the S&P and across the broader market as well. So this is improving here. And then we look at a 10-day average of the highs and lows for the S&P. We got close to this 50 level. 50 is the line between positive and negative. We never went negative here, and now we're starting to come back up. This is longer term, and this shows that some of the more internal measures that we use, new highs, new lows, they're showing some strength now, and that could be positive for the market. And we're coming back up and just barely negative here with the 5-period moving average of the highs and lows across the broad market. We were dropping down here, now starting to come back up. So this is improving. And then we look at a ratio between US and international stocks, still range bound, not really showing any conviction there. Then stockcharts.com, they come out every day with their predefined alerts. And these deal with indexes, they deal with sectors, they even have Canada thrown into the mix here. And when it's positive, it's green. When it's negative, it's red. Well, we had a pretty solid up week here, and look, there's a lot more green. It's almost like St. Patrick's Day here, with just a little bit of red thrown in on the side here. This was earlier in the week when we were seeing a bit of a pullback later in the day, but we can just see from this that yeah, it was a positive week. There was a lot of positive technical triggers that were or alerts that were triggered throughout the week. All right, then we rank the different indexes on a score of 0 to 100. And the higher the score, the better looking. Now, it's kind of interesting. Back in first place, which had been in last place for a long time, but then improving are the small caps. This is the IWM. It's the ETF for the Russell 2000 Small Cap Index. Really improving, coming up into the 90 range. Again, small caps like the fact that the market is anticipating that there'll be a rate cut when the Fed makes their announcement on December 10th. And in second place is the NASDAQ. This is the ETF for the NASDAQ composite. Not really changing all that much, but still coming in with a score above 90. And that shows strong action as far as from a technical analysis perspective. Then in third place is the NASDAQ 100 is represented by the Qs coming in at 86.2. We want this one to do better. This when the QQQs do better because all the stocks that are in the NASDAQ 100 are also in the S&P 500. And so those are growth-oriented stocks. And if they really kick into gear and start moving higher, that also helps the S&P. But this is still a respectable score coming in at 86.2. Then we have the S&P, which is growth and value together and a lot more stocks. There are 503 stocks in the S&P 500. And a little bit weaker here. We would like to see this improve and see the growth areas of the S&P really see some favor and start to go up, but it's coming in at 79.7. Then we have the Dow, which is only 30 stocks, but it's holding up okay, not doing great, but it's at 69.3. And then the mid caps, which just a week or so ago we were getting down in here to really low readings into the 20s. Well, because of this possibility of a rate cut in December, the mid caps have really improved. These are smaller companies. With the small caps and mid caps, they have to pay more when interest rates are higher. Their earnings tend to do better when interest rates are lower. And so if there's a hint of rates being cut, both the small caps and the mid caps tend to perform better. And we're seeing a real improvement here. All right, then we have a short-term rainbow. I have been using this in the daily videos because we were coming down and dropping below the rainbow. And this shows from 10 periods up to 50 periods with simple moving averages. And the longer we stayed down here, the more we were starting to see the lines roll over. And that's what we were watching for here. But then we broke back up and we're starting to get back up out of the rainbow now. If we can stay up here, the lines will eventually turn back up, smooth out, and possibly continue to go up. And that shows more of a stronger short-term trend. Then we are above the 20 period simple and exponential moving averages. I didn't show that in the video just because I have another chart that shows all the moving averages together. And this is why we're back to looking positive in the short term again. And then we are improving with the advanced decline ratio. This is based on price. That's above zero and showing some strength there. We're also above zero and going up based on volume. And then we were really relying on this. When we were coming down, we were watching this anchored weighted moving average here. We broke down below the orange one, which is shorter term, but we came down to this kind of mustard colored one. This is measured from the breakout that we saw. That area held. And about when we hit this is about when we bottomed. And at least to this point, we've been bouncing back up. We got back above this shorter term anchored weighted moving average. And so this is another support level that held. Even though we dropped below the 50-day moving averages, which is a big deal, and the market was starting to freak out over that, the fact that this other anchored weighted moving average that held, that's still a legitimate area of support as well, and is helping to improve things. And since we're back above all of the lines, I stopped using this in the video. Intermediate term rainbow. We came all the way down, started to drop below the rainbow. This goes from 50 periods up to 100. We came down to the 100-day moving average, and that was another area of support that lined up with that anchored weighted moving average that I just showed. And now we've been coming back up. Now, this happened fairly quickly when we came down into the rainbow, so the lines really haven't rolled over yet. They're slowing down, but again, if we can get back above this and stay above it, these lines will start to go back up and look more smooth. All right, then here's the 50 period moving average. We were able to recapture that. A week ago, we lost it. We dropped down below it here, but those other areas of support held, and now we were able to get back above this. This is why we're positive in the intermediate term. Then the 100-day moving average. This held as an area of support, and we bounced up off of that. So it's nice to see these things ahead of time and say, okay, watch out for this. We came down here and then we bounced up from that. And it's like, okay, all right, we're holding its support for right now. Then the Connors RSI, it is positive here. It really moves up and down quickly on a daily basis. I only use this when we get an extreme positive or negative reading. Then when we were really coming down, we were getting an extreme negative reading. But since that time, we bounced up out of that. And Landry Light, this is a trend-based system here. It's not really sure what it wants to do. It was starting to turn a little bit more positive, then negative, and now it's right at zero. So we'll just let this one kind of think about things for a little while before I put it back into the daily video. And a very similar story here with the proper order, another trend-based type of measurement tool. And we had actually gone neutral here. That's when it's more yellow, goes into this yellow area. Then we were turning more negative, then we're back to neutral, and it still really isn't quite sure what's happening right now. So we're not really getting any insight from this chart, so I dropped it out of the daily video. And the percent B indicator, when we were coming down for a very brief period of time, we closed down below the lower Bollinger Band, and that's what the percent B indicator measures here. Since that time, we bounced back up. We're no longer extreme. We're crossing above the midpoint, so this is actually turning back and looking more positive. And another support area that held was the Ichimoku cloud. That's why I look at a lot of different things. If you just look at one or two things and then that support is blown, you may reach a conclusion where other support that maybe you're not looking at, well, that ends up holding. It's like, oh, okay, I didn't really do that one. I got out at the wrong time or I got in at the wrong time. But we held up just at the lower end of this Ichimoku cloud here before bouncing back up. So there's some improvement there. And since we're up out of the cloud, I stopped using this in the daily video. Mass index not generating a signal right now, and we're not getting a signal from the praying bottom fisher. We want to keep an eye on the S&P 100. It's still doing okay. We want the bigger stocks in the S&P, which is the S&P 100, to outperform the S&P 500. That's when the index really starts to move. And it's doing okay, but not as we'd like it to do even better than what it's doing when we look at some of the other ratios between these two indexes, the S&P 100 and 500. Then a long-term rainbow, and we didn't spend much time in here, so the lines really haven't slowed down all that much, and now we're coming back up out of the rainbow. So this is showing that the long-term trend, which wasn't really in danger, at least yet, it took a little bit of a hit here and made things a little bit nerve-wracking, but now we're starting to come back and looking more positive. And then we look at a long-term special K oscillator. Even though this is coming down, it's still positive. At some point, if we do start to go back up, we would like to see this turn and go back up because it is showing a little bit of weakness. But when it's above the red line, it is taken as positive. All right, then we look at a weekly chart of the S&P, weekly chart of the German DAX, still neutral, and that's what we've been seeing. Where the S&P's been moving around and going up and down, the German DAX is just kind of chopping along sideways. Where earlier in the year it was really outperforming and doing a lot better. Then some support and resistance. We were watching this as we were falling down below it, and we tried to bounce up here, and this acts as resistance when we're below it and come up. And then it could act as support as we're coming down, but we sliced through that pretty quick here. Now we've come back up again from this little mini rainbow, and now we're above it. And what all this mini rainbow is a 20 period moving average of the open, high, low, and close. And so I stopped showing this because we're back above the rainbow again. Then some broad market measures. This is the QQQs. We also regained the 20 period moving average here. That's positive. We want this to do better because the better the QQQs do, the better the S&P will do. And even though we lost the 20 and 50 period moving averages, we were able to get those back. And we look at the Vixen, which is the volatility measure for the NASDAQ 100. I don't use this one all that much, but since the NASDAQ 100 has been going back up, we've been seeing a real drop off here with the volatility of the NASDAQ 100. And then we do a comparison here, the S&P to a growth to value ratio. The Qs, which is growth, and the diamonds, which is considered to be value. Not a real strong reading here, a slight tendency to go in the same direction. This is part of the concern that we're having. We want this ratio to go up. That means growth is outperforming value. And we're not seeing that in a lot of different areas. Now, it could improve, and we'll be watching to see if there is an improvement here. But in the meantime, the market's looking a little bit vulnerable because it's more of the value areas like healthcare and some of the rest of the stocks in the S&P. They're doing okay. We need the growth areas to come back in and really take leadership, and that would really help drive the indexes back up. So what we want is this ratio to go up, the S&P to go up, and then the correlation to actually get stronger, meaning that they're going in the same direction at the same time. We keep an eye on the transports, which did have a little bit of a breakout here. There was the grounding of the Airbus. I don't know where things are at right now. I'll have to see how the news sorts that out. But is that going to do some damage to the transports? They had a pretty good day on Friday, and they've been improving here. But still, on a relative basis, the transports, which is the red index here, it's still continuing to underperform the Dow. The bank ETF, which came down, was dealing with its 200-day moving average. You could make a case that this might be a double bottom here, which could end up being positive. And we were able to get back above the 50-day moving average. Haven't really moved all that much over the last few sessions, but we have seen some improvement here. And then this is a ratio between the regional banks, the smaller banks, and the financial sector. Still in a downtrend, but we're above both moving averages right now. Not seeing an awful lot of conviction. We want to keep an eye on this to see if any kind of problems start to develop or at least be announced with the smaller banks. And then we're keeping an eye on the financial sector, which going back to last spring continues to underperform the S&P. And so to kind of go with that, we're looking at some other financial measurements here. This is the ARC FinTech Innovation ETF. This uses finance tech together, but there's still finance in the overall equation. And to see, okay, we're not really seeing any strength in the financial sector compared to the S&P. What do we see from this chart? And we saw some weakness. We came down and actually fell below the 200-day moving average, but we were able to get back above that. Then we look at the ratio between the two, and the weakness that we're seeing here is kind of the same weakness we're seeing between the financial sector and the S&P. I haven't been showing this because I even stopped showing the financial sector to S&P ratio because it's like, okay, it's still there. I make note of it near the end of the video each day, but unless something really changes, it's like we're just looking at the same chart day after day after day. But this would help things a lot if we could improve and get back above the 200-day moving average and get back to maintaining this positive trend here. Then we look at a ratio between staples to tech. Now, in the bigger picture, as I was pointing out a week ago, we're doing fine. When this ratio goes down, that means staples are underperforming tech, and that means growth is outperforming value. Well, as we started to go down, this ratio came up, and we are pulling back down a little bit here. We want this to really start to drop below the 50-day moving average and continue to go down to be more positive on the market. And it really hasn't changed all that much, at least yet. Similar thing here. Value is underperforming tech, but then it started to outperform here, pulling back a little bit, but we would like this to continue to go down to be more positive. Then energy to the 10-year bond and then a ratio. We really now for the last few years have just gone sideways with this ratio. And then we're still not setting a new all-time high here with the value line geometric index. We set the all-time high in late 2021. And even though we've been setting repeated all-time highs with the Dow, S&P, NASDAQ 100, we have yet to do that with the value line. And that's a bit of a negative divergence. It's longer term. I wouldn't necessarily make a big deal out of it. It's just something that we need to be aware of here, that we just are making a series of lower highs, which longer term could end up being negative. But again, this is longer term. We just want to be aware of this. All right, and then the gold to S&P ratio, still a little bit below this downward sloping resistance area here. So that hasn't broken out yet. And then emerging markets, we had been range bound here. We went up into a higher range where the emerging markets were starting to outperform the developed markets like US and Europe. Now this is dropping down a little bit here as the developed markets are actually doing a little bit better here. And that's what happens when this ratio goes down. So we were in a lower range earlier in the year, then we switched up to a higher range. Now this could actually end up being positive if this ratio continues to drop. That means the developed markets like the US and Europe are starting to outperform the emerging markets. Okay, and we look at the US 10-year yield and subtract the German 10-year yield. Then we plot the US dollar index. Not getting any insight here. The correlation is not very strong. They're not going in opposite directions. Pretty much neutral right now. So we're really not getting any insight from this chart. And then here's the German DAX, which was able to get back above its 200-day moving average, still below the 50, hanging on to an uptrend here, but just an awful lot of sideways movement after it was really doing well earlier in 2025. And then the S&P to German ratio, when this is going up, US stocks are outperforming. And even with us pulling back recently here, we didn't see much of a shift with this overall ratio. So for the most part, this going up, that means US stocks continue to outperform. Some long-term rate of change charts, we were seeing some weakness here based on 250 periods. Now it's starting to tick back up. This is also another longer-term chart, seeing some weakness here, but ticking up with the latest reading. And then the takeaway from this, without going into all the explanation, is the market's not worried about inflation and interest rates right now. When this ratio is going down, that's what the market is telling us. Then we look at another one. We're just going sideways. The market's not worried about inflation or interest rates. Another ratio where it's going down, not worried about inflation or interest rates. So we don't go based on what people are saying or doom and gloom forecasters or somebody who's uncovered some secret holy grail insight to the market. We look at what's the market doing? and the market is not concerned about inflation or interest rates, but this could change. And so we want to keep an eye on these charts. All right, then we look at the long-term bond, which is in blue, the S&P, which is in red, and this is the correlation between the two. Shorter term, pretty strong. They're tending to go in the same direction. Longer term, it's flattening out here, and they're still maintaining a fairly strong longer term correlation. And we look at the long-term bond again, which is in red on this chart, and the Qs, and still trying to turn back up here with the longer term correlation between the two, mainly just for information. And we're still keeping an eye on the 2-year Treasury yield. We've been coming down a little bit here. It's not really acting all that strange currently. And we want to keep an eye on retail. I mean, hey, this Christmas season here, we were seeing some real weakness a week ago. We came down to the 200-day moving average and we were able to bounce up off of that and get back above the 50-day moving average. And so we're seeing a bit of an improvement with the ratio between the retail sector and the S&P after it had been really declining for a long time there. And we're back above 50 with the RSI. So this is showing some improvement. And then this is where we're still a little bit concerned. We have discretionary to staples. Okay, the market was up 3.7% this past week. This ratio has barely been budging and actually still going down. It's improving a little bit here, but we want this ratio to really go up. This is the weighted version, and Tesla and Amazon count for a lot of how this is calculated. To make it a little bit more fair, we look at an equal weight version of discretionary to staples. That's not moving all that much here either. Even though discretionary had a good week, we want to see this doing better, and this is part of the concern that we're having. Now, if this does start to really improve, that's going to be more positive, and that'll give us more confidence. If it doesn't improve, or if these ratios start to really go down with some conviction, then that might make us a little more apprehensive about what's happening in the market. And so then we look at some other ratios. We just kind of flattening out here with tech to utilities after we had been bouncing back up. Uh, but before that, we were declining. Now, we did see some improvement here with biotech to healthcare. So that's looking a little bit better. And then hotels to utilities, this was improving, but then pulled back. This is another discretionary to staples type of approach, or discretionary to value. All right, and then we are improving with some of our benchmark areas of the market. The semiconductors, we'd like to see that. They had a good week. We want them to do even better and outperform and see the index itself continue to go up. Home builders, they like that interest rates might be coming down, so they've been improving. The transports, again, not really breaking out, coming back to where we've been before, but improving more in the short term. Retail, as I pointed out earlier, has been showing some improvement, but still has a ways to go to get back to previous highs. And the regional banks, they did improve, and now they're just kind of chopping sideways recently here. And then looking at the Eurozone, this is another apples to oranges comparison where the Eurozone stocks are now outperforming 3 to 7 year bonds. And we were coming down, falling into the rainbow. Now we're seeing some improvement here. And we look at those stocks in the S&P above their 200-day moving average. We had started to drop below 50, and we were able to get back above that. So this is longer term positive. Then those stocks in the S&P above their 50-day moving average, we were turning negative. We're above 50 and going up. This is showing some improvement here. The mid caps are also improving, as are the small caps. And then we look at a Staples to S&P ratio. Bigger picture, declining. That's positive. That means the S&P is outperforming. Then we ran into some problems here for a lot of November, and this ratio started to go back up. It's now starting to come down, but we want this to continue to go down to continue to be more positive on the market. And this would mean that the growth areas are outperforming the value areas. And then this is another thing I like to point this out. We're not even a week ago, we were not seeing a breakdown here when we look at the S&P to Staples ratio. The breakdown that we saw was at the end of 2021, and then we went into the bear market of 2022. We were coming back down into the rainbow, but now we're starting to go back up. Now, we need this to continue to go up and get above the rainbow and see all the lines, especially the short-term line, start to turn back up. That would be more positive for the market. So we are improving, but we need to see more follow through with this to have more confidence in the market. Thank you. I hope you have a wonderful holiday weekend, and I will talk to you in the next video.